For today's discussion, we will dive deep, highlighting the hypersupply market. This first graph shows the 4 market cycles: recovering, expanding, hypersupply, and declining markets. The next is a donut or wheel shape that looks at the market cycles as well. And I like this because it looks at the gradations between the market cycles. Are we just entering? Are we halfway through? Or are we at the end of the cycle? This is from a website called IRR.com under Viewpoint. It's worth a look. This last graph is from Dave Lindahl. What I like about this graph is it focuses on who has the power. Does the buyer or seller have the power? Buyer's market, seller's market. We will look at what triggers and transition points between the buyers and seller market phase 1 and phase 2 and seller's market phase 1 and phase 2. All 3 of these visuals are used to identify and signify where in the market cycle a certain city or a certain market is located. Why do we do this? Well, to gain insights and create a strategy to effectively operate in that current market. Should you buy? Should you flip? Should you hold? Should you cash flow? Wholesale? Should you sell? Your market selection can dramatically influence your expected returns to the investor. Now, how do you do this? How do you take out risk? Well, first you need to understand where you are at in the market cycle. That's your benchmark. That's your baseline to build on. Next, you need to develop a strategy that will allow you to work in that particular market, then execute on that strategy, and then respond, reposition, re-engage. It really is an active process, but so many investors often overlook this step. Today we are going to focus on the hypersupply market and look at what triggers, characteristics, and strategies we use to buy and sell a property in this market. Now, the hypersupply market, this is the riskiest of all phases. You're at the top of the market and you're definitely overpaying on properties related to cash flows. If you're selling a property, the time on market increases. Also, the supply and inventory increases as well. Sellers are waiting longer, but they're still getting inflated prices. At this point as well, rent becomes stagnant. It gets harder to push your rents up. You will see new construction in the pipeline. It's going to be excessive. You're going to see these spikes when you look at the market. That's a sign that it's becoming overbuilt. Now, business in general and job growth is beginning to slow. That's an indicator. And you're also not seeing bidding wars like you saw in the previous cycle. In a hypersupply market, what strategy should you employ? Sell. Put yourself into a cash position. How do you do that? By selling. You could sell or even wholesale. The profits you make from the sale of your property should either remain in cash until the market changes to a recovering market, or move the money into another emerging market, or you can invest in another asset class. We know it takes 2 to 3 years to plan, permit, and build a property. Generally, everyone loves real estate. So when builders and speculators take out huge numbers of building permits, you can track those permits, and then you'll know which markets are at greater risk of soon being overbuilt. Now get this, when these properties come online, there are more properties than people to buy or rent. The only way to move inventory is to slash prices and increase concessions in your market. If sellers want to move quickly out of a market, they lower their price. All investors now see the market has topped out and it's beginning to decline. For the past 2 years, countless people have been waving the hypersupply flag, and now the decline is here. And once again, unfortunately, there are operators who overpaid on properties in this cycle with skinny cash flows and no recognizable appreciation, and now they're in trouble. 2 market forces will warn you about a dangerous transition into a seller's market phase 2. First, jobs. When jobs become stagnant or leave or close, that's a sign. Without jobs, an area will not employ population growth, so population will go down and demand for properties will be less. A second force is supply. Tracking supply and inventory in the market is important. With more properties on the market, owners will need to slash prices or increase concessions. What if you have a property in a hypersupply market and either can't sell or don't want to sell? What do? Well, make sure you have plenty of equity. People who got into deals using only 20% equity in a property often get wiped out at this stage. So if you have, say, 50% equity, loan to value, you're in a much safer place. In fact, Freddie and Fannie are now requiring higher amounts of equity to avoid any issues that you might have down the road during this phase. Now, that's actually a good rule of thumb to keep you safe. You also need to know what your break-even point is and can you cover your expenses during a tough time. Do it right now. Know your numbers. As JT Fox says, what gets measured gets managed. What gets managed gets rewarded. So be prepared to reward yourself by knowing your numbers and know your markets and the indicators and characteristics that will move and affect your market. So you can properly position yourself and your business, and more importantly, do it for your investors. Top of the market is not the place to be. I trust you now see the value of understanding and executing the proper strategy in a hypersupply market. Let me know your thoughts on hypersupply markets. Check out our next video where we will explore strategies to employ in a declining market. Make sure you like and subscribe to our channel. We drop new videos every Tuesday and Friday, so ring that bell and be the first to see our new content. I'm Phil Russo. Stay tuned and stay informed.